Welcome back to my channel where I talk about UK tax-free ISA and how to make the best of it. Now, a really important event happened yesterday, which influences all of our stocks in the US, which many of us purchase through our UK tax-free ISAs. And it really highlighted what I was talking about in the last video, which is the power of inflation and interest rate on the stock market. So in my last video, I talked about how inflation was meant to be 2.7%. So it had gone up since October for November, as you can see here on the chart, 2.7%. Now it came in as expected at 2.7%. And on that day, there was some change in the market, but not a massive amount of volatility because that was as predicted. Now, a big thing happened yesterday. So basically we had Jerome Powell speak, and so he speaks about the US interest rates, and he cuts interest rates or raises interest rates. And as interest rate is relatively low, still 2.7%, the forecast was that he would cut interest rates from 4.75 to 4.5%. So that was the consensus, that was the forecast. I remember we talked last time about how basically the market factors these in. Now that's the most important bit to think about, is the market factors in what it thinks is going to happen. So the market thought interest rates would go to 4.5 and they went to 4.5. Okay, so that's normal. So you might be saying, Henry, why are you making this video? Why is this so important? So 30 minutes after they release the rate, Jerome Powell does a speech, and then he has the opportunity to answer some questions. Now, during that speech, he basically talked about how during 2025, there may not be as many interest rate cuts as expected. So everyone's broadly been expecting about a quarter of a point or 0.25% each quarter next year. So that would take us down to maybe 3.5% by the next year. And that's generally what the market's been thinking, what the market's been factoring in, and what people think is going to happen. However, Jerome Powell talked about basically how he doesn't think that was going to happen, and he wanted to temper expectations. And instead of 4 rate cuts next year, there may only be 2 rate cuts. Now, why do we care what the interest rate is if we're looking at shares? So every company wants to borrow money. The higher interest rate, the harder it is to borrow money, and so therefore the less stimulating the economy. High interest rates generally mean basically low amount of borrowing. People are generally poorer, have more money to spend, have less things to buy, and therefore it's bad news basically. Low interest rate is good, high interest rate is bad. And therefore it was a bit of a shock to the market that basically interest rates aren't going to fall as much interest rates aren't going to fall as much in 2025 as expected. Now, if we look at the market, so we look at the chart, so let's look at Amazon. So you can see Amazon was trading at around 2:30 until yesterday at around 6:30 p.m., 7 p.m. when the announcement was made and Jerome Powell started talking, and then it dropped and it lost 10 points, so nearly 5%. Now let's look at another stock, JP Morgan. Again, same time, went from 240 to 232, lost 4%. Let's look at Vanguard, S&P 500. So that lost, today it's lost 1.5%, so a decent amount. Nvidia, let's look at that. See, again, big sell-off, 3 or 4%. So the Dow Jones in total lost, which is basically the 30 biggest companies in the US. So that lost around 3% when Jerome Powell started talking. So this is a prime example, a really, really important example for all traders and beginner traders in particular, that the stock market is not just priced on relative wealth. It's priced on what people think is going to happen in the future. And that is often more important than what is actually happening. So on paper, just to recap, nothing unexpected happened. Interest rates were expected to fall by 0.25%, and they did fall by 0.25%. They went from 4.75 to 4.5%. However, because of what Jerome Powell said in his speech afterwards about potential less rate cuts than expected next year, that is why the market reacted negatively. And therefore, I encourage people basically not to have too much money at risk during these times, because we can see, for example, there what can happen. So that was something that happened and basically caused the market to crash. Now, let me talk about what I did in response to that. So me personally, what I did, so if I go into history, so I basically bought NVIDIA. So I bought NVIDIA around, in fact, I'll go back on here, it'll be easy to see. So I bought NVIDIA at around so it was up here at 135, 136, crash. I waited for the crash to happen, waited to see some recovery, went back up to 131 or so, or 130, 131. It looked good for more recovery. I bought. So I bought about 10K. It then has gone up and up and up today, slowly up, until it started to peak around 134 and then start falling back down. So I sold around 134 and made £243 profit today. So I also made maybe a bit of money in Vanguard, a bit of money in Microsoft. So my total for the day was around £350, £400 profit. But I just wanted to use this as a good example for how you don't need to be fully invested. You should trade to the market. Don't trade basically just willy-nilly. Don't leave yourself overexposed. If I was overexposed and I had all my money in, I'd be sitting here now sweating, thinking, I don't know when it's going to go back up. Long term, it's a good investment still, but I don't know when it's going to go up. I don't know what's going to happen next in the stock market. However, because I didn't have too much money invested, I had the ability to be able to, after the crash happened, spend 20 grand, and then the next day cash out, make a few percent, and 2%, that 2%, £400. So it's really important to think about that. And it's really important around these events, so around whenever inflation's released, interest rates, anything like that, to think about what you're doing and think about how the market may have an impact on you. And if you're a long-term trader and you're investing £50 a month in Vanguard S&P 500 or some ETF, you don't need to worry about this stuff. But if you're trading individual stocks, certainly in a high volume, as a ratio for how much money you've got, then it's really important to think about this. So far for the month for me, I'll do a recap in another video, but I've just crossed the £1,400 mark for the month. So it's the 20th of the month, or 19th, sorry, £1,400 for the month so far. So I'm hoping, well, 1,500 is usually what I aim for in a month. And so hopefully I can get there, another £100, and that'll close off a good month for me. But really, really, really important to think about what is up and coming and what impact it will have. And yesterday, hopefully no one lost money, but if they did, it's a brilliant example of how to change and what could cause you to win and lose and what to think about next time. And in the future, I hope to make more videos about in more detail about what Jerome Powell will say, what he has said, and what this means in the future. But for now, thank you all for listening, and take it easy.